This is the Syndicate Room, an AI-generated podcast from AdValorem Syndicate. Everything about this show, the voices, the scripts, the production, is created by artificial intelligence. We believe AI content should always be clearly labeled.
Welcome back. It's Monday, and we're doing what we do: market drama, private market gossip, and a little bit of legal finance nerdery, strictly for education.
Exactly. No pitches, no offers, no call your banker. Just research and pattern recognition.
And if you want the daily version of this, it's all at gp.advalorem.io, plus the education library and the insights section.
Also, Discord is discord.gg/gergtp9gts. And if you want to get on the list for community dinners, there's an interest form. Not a reservation, not a promise, just an interest list.
And the community application link is tidycal.com/advalorem/syndicate. Again, education and community, not investment advice.
All right, Sarah. Topic 1. The pre-IPO world is basically saying, congrats, you're liquid. Sort of. There's a bunch of chatter about a 2026 mega-IPO wave resetting the VC secondaries market.
Yes, the big idea is, if the largest, most traded private names finally list, it changes the entire menu for buyers and sellers. You don't just lose companies, you lose the backbone of trading volume.
It's like if the NBA announced LeBron, Steph, and Jokic are leaving the league, and your fantasy league is still supposed to be fun.
Exactly. A lot of the secondary market's liquidity has been concentrated in a handful of must-own names.
Let's explain this in normal human terms. Pre-IPO secondaries are basically employees, early investors, or funds wanting liquidity, and buyers looking to get exposure before a listing.
Right, and when the market gets risk off, the bid-ask spread becomes a canyon. The price is whatever the most desperate seller and least scared buyer can agree on.
So if a mega-IPO wave happens, the question is, does liquidity improve because there's a real public price anchor? Or does secondaries shrink because everyone says, why bother? I'll just buy it in the IPO.
My take, both. The top names get a clean reset, but the long tail gets weirder. If the premium names exit, the remaining private market looks less like a market and more like a collection of bespoke negotiations.
And that's where our quantum pre-IPO analysis vertical comes in. Not as a buy list, but as a framework. What drives liquidity? What drives information risk? And why some names trade weekly while others trade never.
Also, people forget, secondaries aren't just about price. They're about constraints, transfer approvals, ROFRs, who's allowed on the cap table, and timing.
Ha ha ha. Nothing says modern finance like emailing a PDF to ask permission to sell the thing you already own.
Topic 2. Venture funding data is basically screaming, AI ate the capital markets. Q1 looked like venture funding on performance-enhancing drugs.
And the punchline is concentration. A small number of mega rounds can make the whole ecosystem look healthy, while the median founder is eating instant ramen and refreshing their inbox.
This is the barbell. Huge checks into frontier labs and compute-heavy plays, while early stage gets more selective and arguably more brutal.
It's not just AI is hot. It's AI is infrastructure now. People are underwriting CapEx and energy bills like it's 2012 AWS all over again.
Which is why the conversation shifts from cool demo to unit economics, distribution, and defensibility. If your moat is a prompt, congratulations, you built a sandcastle.
Okay, but to be fair, some sandcastles are beautiful.
They are. They're just not venture-scale defensible.
In our AI robotics research vertical, we try to separate robots as content from robots as labor. The second category lives and dies by deployment and reliability.
And it ties back to pre-IPO too. When late stage is awash in capital, valuations can float away from what the secondary market will actually pay. Secondaries become the lie detector.
Topic 3. Litigation finance is having its grown-up era moment. New funds closing, bigger checks, more institutional vibes.
Yes, and the story isn't just more money, it's better plumbing. Portfolio construction, risk management, and reporting have to evolve if the asset class scales.
And a lot of people still misunderstand litigation finance. It's not, let's sue everyone. It's capital that funds legal claims, often so companies can manage litigation risk and cash flow.
Plus, there's a huge difference between consumer legal funding and commercial litigation funding. Different ethics, different rules, different risk profiles.
We've done education on warrant enforcement too, like the new chip warrant case study and accelerator warrant enforcement explainers, because it sits at this weird intersection of contracts, incentives, and founders learning what they signed.
And here's the spicy bit. Transparency and regulation keep coming up. Courts, lawmakers, everyone wants to know who's backing what, partly for conflicts, partly for fairness, partly because nobody likes surprises.
And because when an asset class gets big enough, it gets regulated. That's the rule of the universe.
The investing takeaway, educationally, is that maturation usually lowers the cowboy premium. Early on, returns can be high because the process is messy. As it institutionalizes, returns compress, but capacity increases.
Let's tie these together. Mega-IPOs might drain the most liquid names out of private markets. AI mega rounds might keep private valuations inflated. And litigation finance is quietly building infrastructure while everyone's distracted by robots.
So the meta theme is price discovery. Public markets are price discovery. Secondaries are imperfect price discovery. Litigation outcomes are extremely expensive price discovery.
The world's most dramatic spreadsheet.
And if you're building in any of these areas, the adult move is to plan for liquidity and governance early. Don't wait until you need it.
Quick housekeeping. gp.advalorem.io has the daily research drops, and the education library lives at gp.advalorem.io/#education. Insights are at gp.advalorem.io/insights/.
Discord again, discord.gg/gergtp9gts. Substack is advalorem.substack.com. And if you want to apply to the community, it's tidycal.com/advalorem/syndicate.
Next episode drops Thursday. Same time, same feed.
This has been the Syndicate Room. Reminder, this podcast is AI-generated. Voices, script, and production. And everything here is educational only, not investment advice, not an offer, and not a solicitation.